We have talked a lot about the gold rush analogy in this series. In a gold rush, the smart money sells the shovels. It is a cliche, but it usually works. But what happens when the gold rush becomes so intense and so constrained that one company manages to sell you both the shovel and the map to the gold and the right to use the road to get there?
That is exactly the dynamic we are seeing in the industrial supply chain for artificial intelligence right now. Silicon Valley is writing the checks, but the true bottleneck kings of the AI era are the heavy industrial manufacturers who build the physical infrastructure the chips rely on.
Welcome back to the Working Thesis. Today, we are looking at the business of the double bottleneck. We are going to examine what happens to a company's order book when it controls the two most constrained, desperate components of the entire AI build-out.
And to explore this, we are going to look at one company in particular as an illustrative example. It is a company that effectively acts as a toll booth for the $2 trillion backlog we have been tracking.
Quick, honest note before we dig in. This is just two curious people thinking out loud for learning and for fun. It's not investment advice and never a buy or sell call. So always do your own homework. Before we dive into the specific company, let's briefly review the two massive constraints we identified in episodes 4 and 7. The first is long-term. To move power across the grid and step it down for data centers, you need large power transformers.
And as we established, the wait time for a heavy-duty transformer can be up to 4 or 5 years due to severe shortages in specialized electrical steel. That is bottleneck number 1.
The second constraint is near-term. Because the grid is saturated, data centers are bypassing it by building their own on-site natural gas power plants. But to do that, you need a heavy-duty gas turbine.
And those gas turbines are booked solid out to roughly 2028. That is bottleneck number 2. So if you are a hyperscaler, you are trapped between a 5-year wait for a transformer and a multi-year wait for a gas turbine.
Now, imagine an industrial company that manufactures both of these things. A company that builds the massive gas turbines that power the data centers today and also builds the grid equipment and transformers that will power them tomorrow.
To understand this dynamic, we are going to use GE Vernova as an example. Now, let's be explicitly clear right here. This is an illustration of a business model, not a stock recommendation. We're looking at them strictly to understand the mechanics of the AI infrastructure crunch.
The reason we are using them as our example is that they sit precisely at the intersection of both bottlenecks. They are one of the 3 members of the gas turbine oligopoly, and through their joint ventures and grid businesses, they are a massive supplier of transformers and electrical switchgear.
They are effectively selling both the short-term bypass and the long-term solution. When the tech industry realizes they're bottlenecked, the first phone call they make is to the chip designers. The very next phone call is to the heavy industrial manufacturers.
The result of sitting at the center of that intersection is staggering. When we talk about AI backlogs, we usually talk about cloud contracts. But look at the physical backlog.
In early 2026, GE Vernova reported a record total backlog of roughly $163 billion. That is not software revenue. That is hard, physical, heavy machinery and services that the world has ordered but has not yet received.
To put that in perspective, their orders in that quarter were up 71% year over year. You simply do not see 71% order growth in mature, century-old heavy industrial manufacturing unless a massive, structural, macroeconomic shock is occurring.
And that shock is AI. The tech industry's frantic pivot to natural gas is reflected right there in the ledger. Out of that massive total, their gas turbine-related backlog sits at roughly $76 billion. That represents roughly 100 gigawatts of power generation just waiting to be built.
That 100 gigawatt number should sound very familiar. It mirrors the exact scale of the behind-the-meter natural gas scramble we discussed in our last episode. Every time a data center decides to build its own power plant, these order books grow.
The hyperscalers are essentially outsourcing their power panic. They have the capital, but they lack the heavy engineering capability. So they hand billions of dollars to the industrial sector and say, build us the power, whatever it takes.
And the industrial sector is responding by locking them into long-term contracts. Because the supply of gas turbines is so incredibly tight, the manufacturers have immense pricing power. They dictate the terms, and the tech giants have no choice but to accept them.
Chips get the magazine covers. Software CEOs give the keynote speeches. but the company that keeps the lights on gets the 10-year, multi-billion-dollar backlog.
But the story doesn't end with gas turbines. Remember the other side of the double bottleneck? The grid. Even if you generate the power on-site, you still need to route it, condition it, and step it down inside the data center campus.
And this is where the scale of the AI demand becomes almost difficult to comprehend. In the first quarter of 2026 alone, this one industrial example saw $2.4 billion in orders specifically for data center electrification equipment.
That includes the massive transformers, the switchgear, and the substations. To put that $2.4 billion figure in context, that is more data center electrification orders in a single quarter than they saw in the entire fiscal year of 2025.
The acceleration is parabolic. It proves that the bottleneck is not easing. It is actually compounding as more capital flows into the AI space. The hardware required just to plug the servers into the wall is flying off the shelves faster than it can be manufactured.
A significant piece of that electrification puzzle relies on joint ventures. Because manufacturing things like transformers is so resource-intensive, companies often pool their resources.
For example, the Prolec-GE joint venture is a critical artery for supplying transformers to the North American market. When a hyperscaler needs to step down voltage for a new campus, they are often relying on the output of these specific, highly constrained manufacturing facilities.
And because the lead times for these transformers are stretching out to 4 or 5 years, the manufacturers have unparalleled visibility into their future revenue. They know exactly what they are building for the rest of the decade.
It changes the fundamental nature of the business. They aren't hunting for customers anymore. They are managing an allocation process. They are deciding which data center gets the transformer and which one has to wait in the dark.
This brings us to a fascinating structural debate in the market. If you are an investor watching this AI build-out, you are constantly weighing the benefits of a pure-play company versus a diversified industrial conglomerate.
A pure-play company might only make cooling systems or only make transformers. If they execute perfectly, their upside is incredibly concentrated. But they are entirely dependent on that one specific link in the chain holding.
A diversified industrial model. A company that makes the wind turbines, the gas turbines, the grid software, and the transformers acts more like an index fund for the physical constraints of AI.
If the grid queue clears up, they sell more transformers. If the grid stays congested, they sell more gas turbines. They are hedged against the specific path the tech industry takes because every path requires heavy electrical equipment.
However, there is a massive caveat to this entire thesis, and it is a risk we must state explicitly. When an industrial company accumulates a $163 billion backlog and sees its orders jump 71%, the broader market notices.
And when the market notices, the valuation of the company skyrockets. These industrial names are currently richly valued. They are no longer sleepy, dividend-paying utility suppliers. They are being priced as critical AI infrastructure plays.
Which means they are priced for flawless execution. The risk here isn't a lack of demand. The risk is that building a gas turbine or a 400-ton transformer is incredibly difficult, physically dangerous work subject to supply chain shocks, labor strikes, and raw material shortages.
If the price of grain-oriented electrical steel spikes, or if a factory line goes down, that massive backlog suddenly becomes a liability. A contract is only profitable if you can actually manufacture the machine at the margin you predicted years ago.
Beyond the specific companies, this double bottleneck dynamic tells us something profound about the macroeconomic impact of AI. The capital is not staying in Silicon Valley. It is cascading out into the traditional industrial heartland.
The billions of dollars raised by AI startups are eventually flowing into the order books of companies that forge steel, wind, copper wire, and assemble combustion engines. It is an industrial renaissance funded entirely by cognitive algorithms.
It proves that the AI revolution is not ethereal. It is the most physically demanding, resource-intensive technological shift since the Industrial Revolution itself. And the companies that control those physical resources hold an immense amount of leverage.
The tech giants may own the models, but the bottleneck kings own the physics. And in the physical world, physics always has the final say.
So, we have established that the United States is currently trapped in a web of power constraints, transformer shortages, and grid delays. The brightest minds in the world are currently fighting over access to gas turbines and copper wire.
But what if you didn't have to fight for power? What if you had a centralized grid, massive infrastructure already in place, and electricity that cost less than half of what the US pays?
Next time on The Working Thesis, we look across the Pacific. We are going to explore China's secret weapon in the global AI race: cheap, abundant power. We will look at a dam in Tibet that could power the UK and ask a very provocative question.
If the US has the chips and China has the power, could the future of AI look a lot like the history of Bitcoin? We explore the geopolitics of electricity in episode 9. See you then.
That's a wrap for today. Thanks for thinking it through with us. We're just testing our theses out loud, one day at a time.
Catch you on the next one. Stay curious and tell us where we're wrong.